Hello, I'm Kevin McCaffrey, and I thank you for joining us for the Private Markets Insider webinar. I'm sharing the agenda on the screen, and I'd like to kick off with a few quick program notes. We have a simple program today with a group of investors discussing secondaries, co-investing, blockchain, and once esoteric themes going mainstream. Also, please note that the following presentation is for informational purposes only. None of the information shared or the opinions given are to be construed as an offer to buy or sell a security. And if you have any questions for the speakers during the program, certainly encourage that and use the Q&A feature you'll see on your screen toward the bottom. And we'll answer as many questions as we can during this webinar. And we will follow up afterward to answer any remaining questions and to have conversations where appropriate. That's the point here, is to create good conversations among insiders in the business. So these details and more, including speaker biographies, are available on our website at privatemarketsinsider.com. And now I'll take down the agenda here. Okay, hello everyone. I'm Kevin McCaffrey with Private Markets Insider, and I thank you for joining our webinar. I'd like to acknowledge the people of Ukraine in this moment, and frankly, it's hard to speak in a calculated manner about investing in the future as we witness the tragedy unfolding for the Ukrainian people and the loss of life they continue to suffer. The shock from the invasion has been widespread, and New York in particular has a large number of friends and family who are gravely impacted. My heart goes out to them. And like the pandemic that still affects us, the latest international crisis demonstrates the fragility of what we consider normal. And it illustrates how interconnected we all are. In times like these, we need to trust in our communities to work. We need to trust that the stewards of our community will help us to manage risks, find solutions, and carry on. And in this business, in a less dramatic but still significant manner, we trust in insiders within the private markets community to help us manage risks, find solutions, and take positive steps moving forward. The deep expertise and longer-term view prevalent in private equity, for instance, has allowed investors, including pensions, family offices, and others, to insulate themselves from some of the public market volatility, some of the pitfalls. And of course, no one's winning any humanitarian awards here for what we're doing. We're seeking attractive returns, but it is important to those who rely on returns for their livelihood and those that make a living executing these strategies that ultimately become what everyone's favorite term, the new normal. So keep in mind that private equity was once a niche group of bootstrappers doing deals, and after decades of capital pouring in, propelling outperformance across several cycles, PE is no longer niche, and it's now divided into a bunch of buckets that are getting pretty big themselves. And as we see strategies develop, everyone needs to decide, is this right for me? Does it fit my mandate? Do I like the team? Do I trust it? So what strategies should we be talking about? Well, based on the trusted expertise of our speakers, we chose a few relevant areas: secondaries, co-investing, blockchain, and once esoteric themes going mainstream. So with that, I'd like to ask each of our speakers to kindly introduce themselves. And I'll start with John Dickie at Aberdeen. And actually, I'm noticing the Aberdeen Standard has been rebranded. You've cut out all the vowels. So very, very current there, John. But thanks for joining us. If you could introduce yourself, your role, your firm, and share any once esoteric trend that has surprised you personally. I don't care if it's private equity or the pet rock, anything that comes to mind. So go ahead and please, John.
Great. Well, thanks, Kevin, for the introductions, and good morning, everybody. Thanks for the time today. So my name is John Dickie. I am one of the co-heads of our U.S. private equity program here at Aberdeen. Aberdeen is a large global asset management firm with offices around the world, managing about $650 billion in total. Our U.S. private equity team is all based in Boston. We have been investing in U.S. private equity since the mid-1990s and have had a dedicated fund series since 2000. We are currently investing out of our 9th fund, which is a $500 million vehicle. In total, our program manages about $3 billion. Our focus is on the lower middle market or small cap U.S. private equity. Basically, that means we're backing and investing in founder-owned companies. And we do that through making primary fund commitments to small managers, 100, 200, 300 million in size, actively co-investing alongside of them, and then opportunistically making secondary investments as well, including in GP-led situations, which I know will be a topic we'll get onto today. So that's a bit of the introduction. In terms of your question, Kevin, I think what I would choose to say, and it will tie into some of the comments we'll have, I'm sure, later on today, is I have been surprised at how much the independent sponsor community has evolved and institutionalized over the last number of years. There's always been folks out there doing one-off private equity deals for a long time, but that ecosystem has grown quite significantly, become much more interesting, at least in our opinion, and has become much more institutionalized. And I'm happy to go into more depth on that, but that's a topic we're thinking a lot about in terms of how to play that, how to co-invest alongside those very credible groups.
Yeah, thank you for that, John. And I'll move on to Nash Waterman. And Nash, I know that you just joined. If you're not ready, I can go down the list. But Nash, are you able to introduce yourself?
Yeah, I'm happy to join, Kevin. Thank you. Thanks, everyone, for joining us this morning. My name is Nash Waterman. I am head of the secondaries practice at Morgan Stanley. I've been with the firm about 20 years now. I think probably notable to mention about our group is that we focus almost purely on GP-led deals, purely on the single asset deals that people call continuation funds. Our funds are designed like that, so we've been in the middle of all this. In terms of something esoteric that I've seen, I mean, I actually think that we're doing it right now. If you told me 2 years ago that we'd be doing most conferences over video conference or most GP and marketing meetings over video conference, I would have thought that would have been science fiction, but clearly it's not.
Well, you're speaking my language. Most of you know me from the days of live conferences, and I still believe that those relationships are key, but we'll move on to the next introduction. Please, Vishal, go ahead when you're ready.
Thanks very much, Kevin, and good morning to everyone in the audience. Thanks for making the time. Vishal Shah, I'm a director at Northleaf Capital, which is a Toronto-based private markets manager, managing a little over $19 billion across private equity, private credits, and infrastructure. Personally, I focus most of my time on primaries investing. I would say the one esoteric theme that's gaining increased prominence over time is GP stakes investing. What started off probably at the larger end of the market, we're starting to see that becoming more and more prevalent with mid-market managers. So looking forward to discussing some of that today.
It's good. Yes, hope we can get to all this. and moving down, Maneesh, if you have a chance.
Sure. Yeah. Hi, everyone. Yeah, my name again is Maneesh Gandhi, and I'm a partner at Evanston Capital Management. We're a Chicago-based firm. Evanston Capital is a fund of funds with approximately $4.7 billion in AUM, investing across alternatives. We primarily manage commingled funds that invest across hedge funds, private equity, venture, and blockchain. And our firm, just in terms of some of the background, was founded in 2002, and our heritage comes from the endowment space, as our primary founder was a CIO for Northwestern University's endowment prior to launching the firm. My focus at the firm has been on private equity and venture capital investing. And my primary focus more recently has been on blockchain investing. So in terms of the thing that has emerged and caught our interest, it has definitely been the blockchain space. I think we always saw the potential, but obviously how quick things move in this environment, and especially since COVID, blockchain's been part of that. And we've kind of built a background in this space. We've been kind of researching, investing in the space since 2016, and kind of last year launched a closed-end blockchain venture fund of funds, which we recently closed.
Excellent, thank you. And we'll certainly dig into that exciting space that has taken up a lot of the oxygen in the room these days. Moving on, Howard, would you be able to introduce yourself, please?
Sure. I'm Howard Gurvitch. Thanks for the invitation today. I run a single family office and have since 2006. As we have currently no family members or other beneficiaries who are currently entitled to or otherwise making demands on our assets. We tend to manage the corpus with a long-term focus. We are generally agnostic between industry sectors, equity and credit, as well as public and private markets. With that said, we try to avoid investing in areas where we don't have sufficient level of knowledge or understanding, preferring to focus on those areas where we think we have deep domain expertise, and quite frankly, where we've had historical success. More concretely, from a portfolio construction perspective, we've got a diversified portfolio of public and private investments. While on an opportunistic basis, we've invested in and are actively involved in several operating businesses, as a general matter, we tend to be passive investors in a portfolio that consists of technology and biotech, venture capital investments, from seed to late stage growth. We have a diversified portfolio of merchant power assets, private equity investments, which we do diversify both via funds and SPVs, as well as direct co-investments. We invest in real estate, as well as a significant number of highly structured credit investments, generally through SPVs, which we have done with a number of the larger asset managers. And I guess the last thing I would say is, as we have no need to be fully invested at any given point in time, including today, we're perfectly comfortable sitting with, fairly comfortable balances of cash or cash equivalents.
Good to know. Was there anything that surprised you? I mean, there's a lot in there, and just as a starting point, maybe something that surprised you in recent years.
Yeah, I am amazed. Not so much by NFTs, because really what they represent is the tokenization of an asset, which I think has, as was started with blockchain technology, enormous implications going forward. But I am amazed, although maybe I shouldn't be, because this euphoria always tends to come before the rationalization. I'm amazed at some of the things that are being created as NFTs, being tokenized, and the extreme, or it appears to me, extreme valuation some of these tokens or assets are receiving.
Interesting. Yeah, well, the applications seem to be just starting, so I think we'll all be surprised. I guess, pardon, I lost my place. Chris Johnson, I think you were our remaining star here, please.
I don't know about a star. Good morning. Thanks for hosting us. I'm Chris Johnson. I work for Knightsbridge Advisors. We're one of the oldest players in venture. Next year will actually be our 40th year. Our heritage is mainly in the fund of fund space. We're currently investing out of our 10th fund of fund, which we have done on a regular basis since the late 80s. Starting about 15 years ago, we began investing in venture secondaries, mainly as a complement to our fund of fund practice. And more recently have spun that out into a separate fund line, of which we're also investing out of. So about a third of my time is fund investing on the fund of fund side of the business. And then the remainder is secondaries investing. And that is both LP stakes, GP-led secondaries, as well as direct investments.
Excellent. Well, that will be relevant when we get into those items. And as a starting point, I have some questions that might be a little more general for everyone can chime in, but I'll start back at the top here with you, John. As public markets volatility and news cycles have kind of given us whiplash in recent weeks. Institutional investors, family offices, and so on try to find a focus, it seems, and find the next set of opportunities for outperformance in private markets. You're tasked with finding options that you trust, but also with some level of differentiation. So what are you doing that's different?
Sure. So, I mean, tying it back to my upfront comments, as I mentioned, our focus is on the smaller end of the market. And so, right there, being able to go after, 100, 200, some cases, $50 to $75 million funds, separates us a bit from some of the other folks investing in the asset class. 30 to 40% of our capital is going into co-investing. And then within that, about a third of that co-investment dollars is going to support investments alongside independent sponsors. And then once we've developed relationships and have done some deals with some independent sponsors, we're able to be an anchor investor in a first-time fund. We do a lot of emerging managers, spin out, split offs, or these graduating independent sponsors. And so, while there's a couple different layers to what I just walked through, the ability to do that in an institutionalized way, meet with individual, principals or partners that are spinning out of firms, provide significant capital to them to do one-off deals for a period of time, and then anchor their first-time funds, and then stick with them for a number of fund cycles. We are told that, from an institutional perspective, we're able to get a sort of a differentiated set of looks on that because we can provide that kind of full suite of capital, equity capital capabilities for, newer emerging managers, including the independent sponsors.
Yeah, thank you. And sticking with the same order here, Nash, what are you doing that's different?
So we take a very targeted approach to the types of companies we look for. One of the real big benefits in the continuation space is that the opportunity set has grown so much that you truly can focus on selection. So through the past 2 years, we've had a view that we're going to continue to face different economic shocks, continue to be surprised by them. Certainly appreciate your words in Ukraine. This was another surprise that's going to shake the markets here. And we end up targeting companies that produce essential products and services to stable end markets, very focused in their domestic markets, whether that's US, whether that's Canada, whether that's countries in Western Europe. And we think that's the best way actually to position ourselves differently as we go through these more challenging times. And you'll see that we are far underweight technology, far underweight financials versus others in there in preparation for what we think will be a very unpredictable few years.
Right, thank you. Vishal, please.
Yeah, we're not necessarily doing anything different. I think we've always valued being able to stick to our knitting. Our core focus is mid-market oriented, and the sort of bookends of that from an underlying company size standpoint is 10 million EBITDA at the low end, about 150 at the upper end, fairly broad spectrum. And so, for us, picking best-in-class GPs, established managers with proven track records, deep domain expertise, et cetera, has been tried and tested. And so we continue to do that today. There is certainly more emphasis, not just with global events over the last few days, but really through COVID over the last couple of years, really identifying GPs that have proven ability to generate liquidity. Track records for the most part across the market have been looking pretty good. We've been in a bull market now for a number of years. And so really trying to isolate, value creation, isolate folks that have generated liquidity is increasingly important. And so that continues to be our focus today.
Right, sure, thank you. And it certainly will come back to some of that selection process, very important. Maneesh, what's different on your end?
Yeah, I think if you look at the history of our firm, we've been able to capitalize on emerging segments. When we were founded in 2002, hedge funds were somewhat similar to what blockchain is today, a shiny looking nice asset class that people didn't understand and wondered why. It seems to be doing well and really didn't, fit into institutional portfolios at the time. And we were able to, emerge as I think a go-to player in that space. Candidly, I don't think a fund of funds that just does a vanilla thing is needed today. There are firms that are already established who are doing that, and investors should go to them. So starting up in those areas. So I think for us as a firm, we've been always looking at what is the next thing coming around, but then bridging that with like, hey, is it just not a hot area, but do we organically really bring something to the table? So the example here is blockchain, where we've been ourselves been really interested and been investing and researching the space. So as it has come about, we said, hey, we bring kind of the chops, we think, to really try to build something here rather than just build it in a backward kind of mentality.
Yeah, thank you. Well, that leads well into Howard's response, partly because, I think a lot of the fund of funds that are out there do believe that there's a reason for a fund of funds to be in the market. And often they're approaching family offices hoping that they value the expertise and the diversity and so on that they can bring to a portfolio. And I don't want to start, ticking off the pitch points for a fund of funds, but I am curious, Howard, as you talk about what you're doing is different, are you trying to do it all yourself? Maybe just pepper that in, and we will dig into this a little bit later.
No, we're not trying to do it all ourselves by any means. We are fully cognizant that there are asset managers out there that have enormous capabilities, resources, and access that we don't have. And so we are more than happy to, on occasion, directly invest in funds which might otherwise provide us access. As I indicated in the opening comments, we invest with a number of asset managers through SPVs and through co-investment vehicles. And so we are happy to do that. We are always happy to partner. And I think that that's an issue that, increasingly, and I can even read you some statistics in a second, but increasingly there's this push by family offices to do direct investing. And I think that that is fraught with peril. Just by way of background, over the last 20 years with this enormous surge in wealth, there's been an increase and perhaps an increase in financial sophistication of the world's wealthy. This has led to the formation of an unprecedented number of family offices. Today, there is something in excess of 10,000 family offices globally, half of which were established over the last 15 years. Collectively, they control in excess of $2 trillion in assets. More relevant is the fact that while most family offices were established to manage a variety of functions, everything from family finances and investments, tax, legal, estate planning, administrative services, and cash management, only a very small percentage of family offices were formed for and are adequately staffed to succeed in the area of direct investment management, including secondaries, co-investments, or blockchain-related investments. And as we can go into, maybe I think it comes up in a subsequent question, the in-house capabilities and staffing that's required to have a chance at being successful doing this directly, it makes it very difficult, particularly for family offices where the principal doesn't come from a sophisticated financial background. And more often than not, even though it's the family offices of private equity founders and other guys, they take up a lot, get a lot of the publicity. Vast number of the family offices that are out there today were formed either as a result of an inheritance or the sale of an operating business, valuable backgrounds, but not necessarily at all applicable to successful direct investing. And I think that there is a real risk, even before you get to adverse selection, but there is real risk in going, in putting out money, particularly in a liquidity-fueled bull market, confusing that for success, where vast majority of these offices would be far, far better off either being LPs or co-investing, perhaps as a result of being an LP, with other asset managers who have all that requisite investment and domain expertise.
Yeah, thank you. And co-investing is an area that we hope to get into a little bit here. But it's interesting to hear your take on maybe the expansion of family offices. Maybe they're getting in over their skis, and maybe some of them got lucky with a quick recovery on some of these directs. But all of that will shake out over time. It's an interesting discussion. Maneesh brings up the point that we need maybe more fund of funds, like a hole in the head. But then again, they're out there. And Chris Johnson, as you come on, you have a deep history in venture investing as a fund of funds, and with that specialty, perhaps you can get better returns than a lot of people could do on their own. So what are you doing that's different, Chris?
Sure. Yeah, and you'll never hear me that people don't need fund of funds, right? So I think, I think two things. One, Howard touched on a great point about directs, and it's something I hear from family office prospects all of the time, that it is truly worrisome how many feel that directs may be an answer to their either tech or venture allocation. And I think we can cover that later. But I know on the fund of fund side of our business, Howard mentioned it as well, is one of access. So we've maintained and nurtured these relationships for going on 4 decades. Our turnover is relatively low in terms of our portfolio construction, but what we're relying upon is both that access as well as persistence of performance. So the DNA of Knightsbridge is similar to the endowment model, where we're trying to keep it relatively steady on the primary fund of fund side of the business, relatively steady exposure to venture, and then harvest those gains to fund future investments. On the secondary side, it's again a game of access, but it's much more knowledge access. So the information we're receiving on the fund of fund side of our business really helps inform, a significant portion of the underwriting for our secondary opportunities. And as well as access to, on the LP or GP led side, knowing or being on a pre-approved list to transact in those companies' portfolios or GP led restructurings is a huge benefit and advantage to us at Knightsbridge as we're looking to transact. So, for me, I think there's the argument we can talk, all day long about portfolio construction, diversification, exposure, both sector and geographical, but the access portion, both from a knowledge-based perspective as well as a relationship base, is pretty vital in the fund of fund side of the business.
Right. Agreed. So all of that brings us into our next question pretty well, around, just the fact that we're coming off a year of record returns in a lot of assets, and you have to find a focus. So if each of you could just quickly, recount your primary focus and why you think, that area has gone mainstream over the years, and how you can continue or can you continue to outperform? John, you want to start back at the top?
Yeah, sure. Thanks. So just as a reminder, our focus is all on small cap U.S. private equity. And why is that mainstream? Is returns have been fantastic, and it's easier to double a $5 to $10 million EBITDA business than it is to double a $100 million business, and investors know that. And so it's a mainstream asset class. Why do I think that's sustainable? Which I do, by the way, even in a rising tide environment, if that were to persist, is because of the supply demand imbalance that we see. From a supply perspective, you literally have unlimited, it feels like, number of founder-owned businesses. Companies are getting started all the time, and they're getting to that $5 to $10 million EBITDA level. And then we're not a lead GP, so we're always partnering alongside one of our GP partners. And there is also a constantly regenerating ecosystem of smaller managers, because you have the spin-offs, split-offs, and graduating independent sponsors. So from a supply perspective for our business, unlimited companies, and frankly, a constantly regenerating ecosystem of people for us to partner with. On the demand side of it, what I'll call the exit side of our business, is 85 to 90% of the capital that's flooding into the private markets, which is a secular shift, not a secular one. That's going to continue to grow, I think, for the life of all of our careers. The dollars are largely coming into the middle and the upper end of the market. The number we cite is 85 to 90% of the dry powder in the capital is in hands of private equity funds, 750 million or greater. And they are absolutely thirsting to buy companies that are in our portfolio ones that were once founder-owned, but now have been professionalized and are proven platforms. And so that barbell, that opportunity to help support and buy founder-owned businesses and sell them up the food chain, or what we call manufacturing inventory for the middle market, I think is something that's quite sustainable for a long period of time.
Yeah, thank you. And Nash, how will you continue to outperform and attract capital and find places to allocate?
And so my view is not so distant from John's in this thought that, where you can find the real alpha is in the lower middle market. Our particular space is focusing on these single asset secondaries, these GP lift outs. And I think that it doesn't get talked about enough, the importance of the fact that GPs are choosing these assets because they live with them and they're the best assets they see in the portfolio. And so we have a natural positive selection, which has led to secondaries having buyout-like returns in our portfolio by high grading these assets. And I think that is the first way to, make it through whatever comes next. I think the second piece is there's a big trend of consolidation across the US and most developed countries. Pressures come from needing more technology. It's too expensive for small businesses. Pressures come from compliance. And in the lower middle market, you're seeing more and more skilled managers rolling up these businesses. And what's so fascinating is that no matter what happens to valuations, these companies can actually buy their way through those ups and downs. And we've seen this happen. And we find that it makes them a particularly robust part of the portfolio. So those are the two ways as we prepare ourselves for what happens going forward and for what's been a very long bull market to make sure we can continue to outperform the markets in general.
Yeah, thank you. Vishal, what do you think?
Yeah, a couple of things for me. I think firstly, we are laser focused on the mid-market and selectively at the large end, but leveraging our 40 plus year history and network, gaining access to top performing GPs remains critical. But there's also a portfolio construction element to this. Our portfolios typically are a combination of primary investments, secondaries, as well as direct investments. And so really sort of fine tuning that balance to optimize returns, trying to push the envelope beyond simply just, passive sort of, post-close syndicated LP co-investments into taking a more, active role, getting involved earlier, getting involved in more structured situations versus common equity, things of that nature have, helped us improve the sort of optimal mix within our portfolios and generate that alpha.
Yeah, interesting. And each of you have your areas where you may be stronger, but a lot of relying on historical networks and so on. Maneesh, moving into your response, you seem to have taken a different tack and really gone after some new innovations. So yeah, how are you outperforming in blockchain in particular?
Yeah, I mean, I think in terms of the catalysts in blockchain, to see, to understand how we got to where we are. I mean, I think the realization has just been that the space is much bigger than just one asset, Bitcoin, which is really what people thought about for blockchain for most of its life. They've come to realize that blockchain technology is spurring kind of a new generation of companies with real fundamentals built on smart contract platforms like Ethereum and layer 1 blockchains. I think also, which we know how investors really tend to pay attention to things, it's the price appreciation. Obviously, the two most visible assets here, Bitcoin and ETH, has just seen kind of crazy price appreciation. And other breakout companies have also seen some, really massive returns. And it's led to this kind of the 2017 to 2020 kind of vintage funds and blockchain, just, seeing, returns of kind of 5x to 50x types of returns. So I think the promise of the technology it was really just a concept, and it's become more tangible, but I'd still say it's still, very early. And the third thing is just the media coverage, right? I mean, the coverage has been unprecedented in this space on this, and that kind of cuts two ways. Media will often bite a story that is really not the real story. for blockchain. So it does some good and it does some bad. In terms of the outperform question, I think there's two vantage points, right? There's the long-term vantage point, which we believe, and we wouldn't be in this space if we didn't think there's really potential for this asset class to outperform, and it should perform. It needs to perform because there is more risk. I think are the ingredients there, right, for these spaces. And if you look at blockchain, it's a differentiated technology, is allowed for the creation of kind of these new business models that didn't exist, and it's allowed for new business models that are disrupting others. And we're seeing glimpses of that, but it's still very early. But what I don't think people realize is that as good as a technology is, you gotta have the ecosystem. And in the last 10 years, really produced the ecosystem here. That's really been the story that has been more hidden. And this is the ecosystem of developers, of investors, of entrepreneurs, of having the needed infrastructure. I mean, it's just amazing how much Web 2 talent is just jumping into the space. So you can have as good of a technology as you want, but if you don't have that ecosystem, you really can't build something. And that's, I think, what really fascinates us in this space. Now, how quickly those ingredients come together, to what degree, that we'll all find out. A lot of what we see today, people didn't know was going to happen 2 years ago. And what happens 2 years, we won't know what will happen. And I think to people saying, hey, are we missed it? Is it too late? Has this been just a fast riser? I mean, to put some perspective, it is early, and the whole, if you take the entire token market, right, it's a roughly 2 trillion-ish, moving around quite a bit right now, kind of market cap. And this is still smaller than an individual company like Microsoft or Google. So, if this technology becomes, and this space becomes what it is, there's always, we think, a lot more room to grow. But in the short term, just to quickly address that, I mean, the space is susceptible to bull and bear markets. It's like anything. If you're going to try to shoot for more industries that can give you this more outperformance or larger return, you're going to get volatility, and this is just like that. So that continues to occur, and you're seeing that, you're seeing that today. And we don't think just because the industry has become more institutional, has seen kind of a transition from just not being only retail, that necessarily diminishes. Maybe it changes the floor or the peak, but that will be there.
Well, thank you. And as I move on to Howard here for a response, it dawns on me that everyone else so far has someone to answer to, and they have a process. Family offices don't have to answer to anyone, and every family office is different. They say if you know one family office, you know one family office. But in your case, Howard, how do you look at trying to outperform? I mean, you've said you're probably a little more traditional, but some of these areas like blockchain, if the press keeps covering the way Maneesh says and money keeps pouring in, the gains are unmistakable. So how are you going about trying to outperform?
Well, I don't know that we're trying to outperform. I think and we don't suffer from FOMO. I think we try and be level-headed. I think in many ways, coming into 2022, we felt as we did in late 2019, which is that valuations looked quite high. And I had no idea how long this liquidity-fueled valuation surge would last. We certainly didn't anticipate COVID. But when we look out at the investable landscape, and we don't really understand what's driving this dynamic, and I'll go in an area where we spend a lot of time because really principally we have a barbell portfolio, which is technology and biotech on one end and structured credit on the other. But when we looked at these valuation increases, they just didn't seem sustainable. We have investment in dozens and dozens of private companies, and they didn't change fundamentally from one quarter or first half of the year to the next half of the year. And yet, in many cases, valuations were doubling. And so when we see that, and we're much more likely to be a seller than a buyer. And again, we don't have a problem with sitting with cash. And an environment like today, just like, in April, May, June, July of 2020, we were comfortable being buyers much more comfortable being a buyer there than being a buyer in late 2019. And again, when we don't understand things or they just seem to defy logic, we're perfectly happy sitting on the side. And sometimes we're right, sometimes we're wrong. Some of Maneesh's comments we agree with very much. I think that, for example, and we spend a great deal of our time and money in technology. I don't have a clue what Bitcoin or Ethereum is worth, and we don't really spend much time trying to figure that out. But I think that the underlying blockchain technology and protocols absolutely are changing the world. We were a seed investor, day one investor in Figure Tech, for example. And we have watched, and we talk about, a number of other companies. What's going on today? Listen, every business, and Nash and John, every business is a technology business today. And if people don't recognize that, they probably won't be in business 5 years from now. Every business is a technology business. And it doesn't mean, again, back to Maneesh's comment, that there won't be bubbles or excess. But when we invest, the way, I guess the short answer to my long answer, we spend a lot of time in technology because it is fundamentally changing the world, and change is happening, at extraordinary speed. And the key for us is it's incumbent upon us to understand the spaces where we're investing, whether we're doing it directly or perhaps more importantly in tech, but particularly in biotech, trying to get ourselves access so that we can partner with those fund managers who have deep domain expertise and access. A real issue for family offices is that they often fall prey to adverse selection, having only secondary or tertiary opportunities presented to them, and then only after more established and experienced investors have been presented with and passed on the opportunity. Compounding the issue is the fact that limited family office staff often lack the experience and the discipline to avoid the temptation to look everywhere and anywhere for investments. We try and be really disciplined in those areas that we invest in. In technology, we want to make sure we understand the TAM. We want to understand the competitive market environment. Increasingly in a lot of technology, it's winner take all. And it's important to understand that. It's important to, and then once you have a sense of where you want to go, I spend a great deal of my time trying to make sure we can secure access and not on an adverse selection basis. And that increasingly requires, the world is awash in capital. So capital isn't a differentiating feature. And the successful investors, and why, for example, in biotech, where we really don't have enough deep domain expertise or access, it's really important to partner with those that do. But again, we don't try and outperform. We just try to avoid or minimize the amount of mistakes we make. And we try and learn, and I've tried to learn over the last 30 years from every experience, particularly the bad ones, and make sure I took the right takeaway so that it informs us in the next investment decision, regardless of the market cycle.
Yeah, well, thank you for that. And I guess, wide range of issues encapsulated there. And Chris, as you go into your response, if you can also, I guess, this brings us a little bit into the next question that I had around, how you're digesting deal multiples in, a pretty fully priced environment, although public markets have signaled a bit of a correction. I don't know if that's filtered through into private markets and so on. So, maybe you can add that into the context of, how you're trying to outperform.
Sure. I think, Howard touched on a good point in the sense of where valuations are at. And I can kind of talk about both sides of our business. So if you think about venture secondaries, what we're often doing is seeing deal flow from sellers similar to Howard, who feel that their portfolio is fully priced. And bigger picture, what that has led to for us, especially in the last, call it 9 months, has been an extreme increase in deal flow. So we're able to better, there's obviously quite a bit more noise, but we're also able to be better laser focused on the signal, right? So we know what we want and what we like, and we're able to get that more often at a price that, makes sense for our portfolio. The deals coming to us now are much greater than the deals we're actively going and hunting for. So it's become kind of a multiple in terms of what we're seeing on the late stage. If you think about our fund of fund side of our business, we really focus on the early stage. And if you look at any statistics about kind of the extreme growth in asset or capital flow into venture, the vast majority of that capital has been on the late stage side. So if you think about our fund of fund side of the business, we're investing in essentially 10-year funds over a 3 to 4 year period, which means our fund of fund is a 15-year vehicle. And if you're thinking about kind of investing in a startup manager now to try and accurately predict what's going to be happening a decade from now, it would be quite a feat. I'm not sure I'd be on this call if I was able to do that, on an exact basis. But what that does by us is thinking about what venture's role is in the economy and what it is, in the GDP, both domestically and globally, right? So if you're thinking about kind of what the growing area is in our current economy, it's those tech companies that have been mentioned numerous times. And so on the fund of fund side of our business, we feel we're well positioned kind of no matter the late stage valuation environment, looking at the early stage. And then on the secondary side of the business, where we're dealing with later stage portfolios, we're able to better pick and choose because of that increase in deal flow.
Yeah, that's interesting how, the GP-led secondaries have given a deeper view into some of these assets. And, I guess arguably applying greater expertise to picking winners and continuing on. And with that, I don't want to run through everyone necessarily in this question. Some of this starts to duplicate, but does anyone else feel free to unmute and give us your comments on deal multiples, because I think it plays right into some of my opening comments around the fact that we have to trust managers have a view on these things. It's not a public market, but it is an open market. So people are trusting you to decide, well, can you get a couple more turns out of this, and is this reasonably valued? So how does everyone feel about deal multiples?
Well, I'll make a comment, again, something that concerns us. Listen, it's clear, particularly in the space where we traffic, that the multiples have come down dramatically. What concerns me, particularly with this geopolitical issues and inflation that is flowing from supply chain disruptions, and now with energy and commodity prices in your markets, one of the things I am concerned about is that the earnings there's a potential for earnings to disappoint. And when that happens, there will be more multiple contraction. And I think we run the risk, at least in certain sectors, or maybe it's just isolated to certain companies, we could run into a spiral here, which is, where people haven't yet factored in the earnings disappointment, especially given how earnings have held up so strongly heretofore, but that there'll be a second order knockdown effect on multiples. And it concerns me about putting out new capital at this point. Then just a sort of a related thing, one of the things about secondaries, now that perhaps the market is getting more difficult, does it become more difficult pricing secondaries, where by definition, oftentimes your pricing data is 3, 6, 9 months old? And yet we're getting into a more difficult, more multiple constrained environment than we had been in previously.
Right, thank you. And I don't know if anyone else wanted to.
Well, it's an interesting question around secondaries. Maybe I'll hop in there too, because one of the benefits you can get from that in terms of determining the real valuation of a business is that you're able to actually work through the business with the owner. The owner's not selling to you. You know, they're going to be invested with you. And that takes away really a lot of the heavy asymmetry that we all deal with in this business, because they live with this company for 4, 5, 6 years. They know the management team. They know what's good. They know what's bad. And so as we're thinking about multiples out there and what we're paying for things, we find it much easier on the secondary side, because we're able to get that view in terms of, has that value creation plan actually worked? And then get a much higher conviction in terms of whether it will work.
Yeah, thank you for that. And, you know, again, blending this into what I see as a next question that I wanted to cover, you know, a lot of how people got comfortable with deal multiples and so on was visiting these companies. And those processes have changed. And, you know, maybe people are back to full visits and getting out on the road and visiting companies and so on. But I'd like to take a litmus test here. We're not talking about COVID as much as we were over the past year, but in the wake of COVID, you know, what are some adjustments that people are taking to their diligence process? And is everyone, you know, getting out there to the same extent? Nash, I'll start with you, since you made a comment about being surprised that you're even doing online events. So I assume you're doing some of your diligence and meetings online and so on. So how's the process changed?
We are doing some of it online. There's probably an intro meeting, which we might have done in person before, that we will not do in person now. We similar to you, we take the view ultimately, especially to meeting management, to meeting GPs, there's no replacing actually sitting down with them in person and that level of communication. So what's changed for us is that every time we've had those meetings over the course of COVID, we've had to get certain permissions and take a bunch of health precautions. But aside from that, we've tried to keep it pretty much business as normal.
Yeah, I would just jump in and say, totally agree that ultimately, before we make an investment, whether it be into a company directly or to a GP, we're getting out on the road. You have to, and spending time with them, having dinner, kicking the tires at a specific company if it's a direct investment for us, for sure. Having said that, we have definitely fundamentally changed how we're approaching our travel. We are doing, I would say for us, more than just the intro meeting over Zoom. You know, we're probably doing, you know, a few meetings over Zoom and then really building to those in-person sessions. Absolutely. And, you know, I think things like conferences, we've done a number of conferences, you know, some of the speed dating that we used to do, we can do that over Zoom. And then the last thing I'd say is, I mean, pre-COVID, our whole team thought nothing of, you know, taking a trip. Let's say we had a specific diligence session. We had to go, you know, we're based in Boston. We had to go to San Francisco for, you know, we fly out on Monday for that one specific meeting, and we would always, you know, tack on a couple of days to hit, you know, whatever, Los Angeles and Seattle, and do a bunch of first-time meetings there because we were on the West Coast. And I think we've, at least for now, been much more targeted of like, let's do that meeting, but let's not burn ourselves for 3-4 days doing some intros. Let's get back to the office, do those intros over Zoom. And one of the things we've observed with that is our throughput, if you will, has been much more efficient. And because we're looking at 300 to 350 co-invests per year, similar number of secondaries per year, 250 to 300 primaries per year. The ability to just, you know, not always be doing that from the road, you know, and trying to read a deck on the plane, you know, we've been processing better. And so it'll evolve, you know, it'll continue to evolve and they leak back towards more travel. But for now, we found it to be pretty darn efficient.
From the internal team building perspective, it's been really helpful because with the ability to go virtual, it's easier to cross staff across offices, to give people broader exposure. But totally agree with John. It's almost, you know, from a sort of fund investment perspective, it's almost like it's flipped, where you would spend a whole bunch of time, you know, Zoom sessions or what have you, with the manager or with the company, and then prior to making an investment, you do the in person, whereas it was probably the other way around pre-COVID.
Only thing I'll add on this is that, to what everyone's saying, is really I think the gap tends to be around, you the people part of it and the partnership part of it. And the part I miss the most is the dinners or the lunches where you're not in meeting mode and you're a little more relaxed and get to know the folks. So I feel like that's the part that's most missing. I mean, the way we've kind of reacted in a lot of what we've done has been more virtual here, and at least specifically talking on the blockchain side, has been more just about reference checking. And I'm sure that's probably something that everyone's been doing more of, because the way that we've looked to fill that gap is through a lot more references and talking to a lot more other peers and others who've had touch points with these managers, just to get comfortable that those parts that you're not getting to see in person are getting you can get comfort around.
Thank you. And some of this plays into a question that came in over the box. We got a few notes there, but one of them was asking about developing private markets in emerging markets, and whether you focused much on some of these green spaces that are out there. I think the US is a much more developed and mature market, but I think people, at least initially, wanted to stick to their knitting and so on. But between Zoom calls and expectations of cutting travel, and people getting back out to travel, are emerging markets a big focus for anyone? Okay, well, that's handled. We've got a lot to get to, so I'm not going to dwell on anything. I guess now that COVID restrictions have lifted, and I guess you're doing diligence through Zoom and so on, is there anything else to be said about an actual change in process and getting back to networking in person? Are you starting to go to events and meet people, or do you have plenty to work through in your existing pipeline? And I guess for that, I'll start with Chris.
Sure. I mean, I think kind of during COVID, what we came to rely much more upon is our fellow LP network, in terms of both referencing and thinking about kind of potential investments. Being kind of where we sit, we're historically relatively slow moving in relationship building, in that the time between introduction and investment for us is pretty lengthy, right? That it's not like a quarter long thing that I'm going to immediately invest in a new manager. And what I've been able to do during this time period is really kind of get back and reconnect with my fellow LP network in terms of both back channeling, referencing, as well as ideation, kind of spitballing different ideas in terms of sectors as well. And I think that's something that will probably stick around. One thing we're still trying to work through is trying to get back to that ops due diligence piece. So, obviously boots on the ground are kind of the best way to walk through a facility, whether it be a direct investment or a manager investment. But, seeing the documentation was something during this time period, but, internally we're still working on, what that process will look like now that we're going back to conferences and site visits.
John, did you have any comments on that? You have a pretty involved process.
I don't have a lot further on that than what I've already said, to be honest with you. I mean, we are trickling back into, one of my partners today is in New York at a live, in-person meeting. So, we definitely are getting back to it. But as I mentioned previously, it's just more targeted than it was before.
Fair enough. So let's shift gears here. I recall 4 or 5 years ago, and I'm not sure exactly when, but a lot of people wanted me to address blockchain and Bitcoin in the conferences that I was running. And, I said it wasn't institutional enough. It was, too esoteric and too tough to value. So this isn't the first time that I missed a big opportunity. I came out of college before the internet, and then I saw the internet bubble burst, and then it blew up again and pushed me out to the margins. So, in a similar fashion, I've been skeptical of crypto, and, so am I doomed to the same fate? And I guess this is directed to you, Maneesh. Tell me how you view this. How do you value opportunities around blockchain, given the kind of nascent nature?
Yeah, sure. Yeah, I mean, for most private assets in blockchain, which today's the universe is still made up of early stage kind of companies, though there have been more later stages that have kind of progressed. I mean, the approach is really similar to traditional venture, right? You'll probably see blockchain managers use a kind of development stage valuation approach. There's a kind of a rule of thumb set by investors in the market, depending on the venture stage of development. And we can all argue if it's too high or too low. And I think more argument would be too high. And then valuations tend to differ around these kind of rules of thumb based on, companies' traction or the quality of founders or the TAM or whatever that is. And then on the public token side, which is really interesting dynamic in this space, because you have a lot of early stage companies that are public and are effectively kind of trading on kind of this public market. There, the valuations are kind of provided, or you can see through a number of sites. But you got to take those at a grain of salt, because a lot of those are very thinly traded, especially the small cap and the mid cap, and they are more prone to speculation. So, I mean, I think obviously, as we've talked all about, and I think that question was a little more addressed in terms of just where we are in the cycle, and that there's obviously a lot of more expensive and higher valuation stuff in the market. You just got to play it long term, right? And I think we've kind of touched on that. We've also focused more on the early stage piece of it, because hope, if the whole space falls out flat on the years, we all lose. But if you're just catching things at a higher part of the market, but you're early stage at a relatively lower valuation, you hopefully, if that company wins, is going to win one way or the other. It might not be a 50x, might be a 35x type of thing. And then it's really just spending time with these managers. I mean, a lot of these managers get caught into this euphoria, and they invest in this infura, and they feel this competitiveness to keep up with people. And then there's people who are just really comfortable in their skin. They have a real mandate and they stick to their mandate. They're more disciplined, they're more focused, and you got to find that. It's not easy to find. I think you need to know and follow kind of managers for a longer period of time. And that. And that's a struggle a little bit with emerging managers, because I think they always do feel right now that they need to kind of keep up, and they're behind to some degree. It's almost a little bit more the established managers are like, okay, I've made a name for myself. I don't need to kind of, win right now. I can win over the longer term, can be right. So yeah, I mean, timing is important in this space. I think market timing tends to be difficult. So I generally advocate for people to buy in over kind of multiple vintages. But it does affect kind of your, it can affect your returns, obviously, if you're at the more expensive side than the cheaper side of the market.
Right. Well, timing is certainly key. And in some of these situations, I think a lot of investors feel like there's a confidence game being played. So yeah, you can average in over time. But also you might need to make decisions quickly without certainly not historical data on that particular market. And that brings us into, the others on the panel here that might be in similar situations around co-investments or GP-leds, direct deals. And, I'm wondering if you're getting more comfortable making those decisions, how you're doing that, what new processes are you putting in place? And maybe you can just, describe a little bit about the journey getting there. And I'll start with John. Would you like to take that? Has your process been changing around, more co-investments and that type of thing?
Yeah, I mean, our co-investment, I think with everything we do, we're trying to get better, every day, every month, every year. As we've done more co-investment, and it's been a journey for us, the way I'm sure it has been for many others. If I look back 10 years ago, we probably did 3 or 4 co-investments 10 years ago in that year. Last year, we did 24 co-investments in calendar 21. So, as we've done more and more, and that's become a more significant part of our capital base, we've obviously had to change our process. That entails everything from hiring more people, and while we're an LP on this, in this asset class, we hire people that come from the GP side. So I came from the GP side. My and multiple partners of mine came from the GP side, and we've hired more folks in recent years that have come from the GP side to help us process that with that type of capability. And then, yeah, we've had to refine, the way we filter through it. We've gone, again, 10 years ago, we probably looked at 50 deals to get to those, 3 to 4 that I alluded to. Now we're looking at 350 to get to those 24 that I mentioned last year. And so, things like scorecards and tear sheets and just being able to process information faster has been really, really critical for us in order to be able to, have as wide of a top of funnel as possibly can. And sourcing has been a big part of that, a much more proactive calling effort, particularly into that independent sponsor universe that I alluded to before, all the way down. I mean, just like we push our GPs to, find opportunities and create opportunities outside of like super, frothy processes, we attempt to do that, in our own way, shape, and form as well.
Yeah, thank you for that. John, if you wouldn't mind, do you have any exposure to crypto or, blockchain in general, just as part of that question?
Yeah, we do. So I help oversee our buyout program. We have internally at Aberdeen a separate team of people and a separate pool of capital focused on early stage venture. And within that, they're investing about 10% of their capital into crypto and the blockchain. It's not my core area of expertise, but we are, as a firm, quite focused on it.
Interesting. Yeah, thank you. And Nash, what's your process around co-investments? And I know in your world, you would probably consider the GP-led secondaries to maybe mix a little with your philosophy on co-investments and so on. And yeah, if you can just shed a little light on that, and if there's any crypto or blockchain in that mix.
Yeah, I mean, well, I'll hit crypto and blockchain first to say we don't have that in our portfolios. I can't speak for Morgan Stanley in general. That may or may not be the case, but that's definitely not my area of expertise. In terms of, for GP-leds, I think that in general, in terms of the due diligence that's required, it needs to lean more to the direct buyout side, because you're not coming into the situation where it's a GP who you work with forever. They've just done due diligence. You can take their packet, review it. That's not preset for you. You're coming in midstream to this deal. You need to put that together. You need to spend the time with the management team to get that information. You need to redo a lot of those efforts. So it's a very deep, very long process in terms of constructing these deals. I think that the other big changes that we're all making to our process is making our ESG and our DEI processes far more robust. I think all stakeholders in this business have seen this as important. This is one we're investing a lot of time in. We're not an ESG or DEI focused fund, but I think as investors, it's now becoming, really a standard for us to maintain.
Howard, do you have any views on, is blockchain a part of your tech mix that you mentioned? And generally, you made some comments about, co-investments, but you are doing some of that. So, are you ramping up your processes and your team in that arena?
Yeah, as I indicated earlier, to our detriment, we haven't invested, other than, very immaterial amount in any of the coins. I don't know how to value them, and as such, we've sat on our hands. But both directly, and I indicated one company, Figure Tech, where we invested in, that is a blockchain-enabled business. And I won't do a commercial on Figure Tech, but it is a business that is 100% native to the blockchain, and it's bringing its expertise to the Wall Street securitization market. That is an area where I think there is enormous opportunity, because there is enormous economic benefit to be gained by having, instant settlement and all the other things that come with it. We are doing direct investments. We've invested in companies that are in the NFT business and otherwise. But I don't know how it will all turn out. I don't know whether we bought in at fair valuation, whether what looked fair, today will have been, excessive or opportunistic, 3, 4, 5 years from now. But we have put a lot of stakes out, as much to make sure that we are staying abreast of what's going on. And hopefully we've done it in a sufficiently diversified and intelligent fashion that at the end of the day, when we add it all up, it was worth the time and money. But that's to be determined. But I think that blockchain is so profound, and its implications have the potential to be so profound that you can't be a technology investor and not have exposure. We are always looking not to the existing FANGs, but to really, what are the FANGs of the future? And that's where I think you have the potential, if you can do it, to create real, wealth. And it's not trying to figure out whether today Microsoft or Netflix or Google or Amazon, is cheap, but trying to figure out where the world is going. And there have been big evolutions in technology over the last 30 years. And when we spend an enormous amount of time and resources trying to figure out how the world is evolving from a technological perspective. And that's, to us, how we can really accrete wealth, if we can get it right in part.
Right, thank you. And I guess, Chris, can you speak to, the Knightsbridge process and exposure in this area?
Sure. So in general, we definitely have crypto, or I'll call it blockchain exposure. Our crypto currency exposure is relatively minimal. I think in general, what Knightsbridge does at least on the fund of fund side of the business, is rely much more upon the GP bench. So we don't necessarily allocate to crypto or blockchain specific funds, but we rely upon the kind of the GP team to have a specialist or some expertise in that area. The other thing, the framework I think about, at least with blockchain and crypto, is, early stage venture, or the managers I'm looking at, are, much more concerned with the picks and shovels. So call it the blockchain aspect, than the kind of the speculative aspect of the cryptocurrencies. So if you think about where historically venture returns have come from, it is that, the picks and shovels, the software, the tech that is the backbone of XYZ industry. So, thinking about getting into that space, as a new investor, I would caution against looking specifically at crypto, and more looking at a firm like Maneesh's that would be more focused on blockchain itself. And then I think from a process perspective, I definitely don't have a view as to the specific value of these currencies, whether or not they're over or undervalued. What interests me the most from a diligence perspective is looking at the aims of the projects that are the underlying investments of our managers, right? That, the inherent value of these currencies is essentially like FX to me, which I'm definitely not a specialist in. So thinking about kind of what the outcome goals are of the actual projects or companies is much more important.
Right, thank you. Well, you all probably saw that Super Bowl commercial featuring Larry David, and comparing crypto to the invention of the wheel. And the problem in my mind was the assumption that this is a one and done deal. Some investors find ways to continually tweak an idea and squeak out more and more returns. And, the wheel, if you look at that, became a wagon, and then the wagon a train, then a car, and now EVs are taking over the auto market. So all along the way, you can find people applying principles of consolidation, operational improvement, leverage, and they make more money than the guy making a blind bet. So, I'm wondering where people come down on these types of innovations and how you play that over time. So that's to transition out of blockchain to talk more about, how people are, I guess, attacking the sectors where they like to focus. And Howard, you spoke a little bit about your areas in biotech and tech in general. And, I wonder, how are you going about, doubling down in some of these areas to invest from venture into growth or growth into buyouts and sticking with these opportunities?
Well, for us, ideally, if we get it right, the investments that we invest in early on when they're early stage companies, we continue to have an ability and to fund as they continue to progress through their life cycle. We were early investors in Rivian. And that's a perfect example. We were investors in Snowflake in the private market, and had participated like we did in Rivian in several rounds. And so for us, we are big believers, in venture. It's a very difficult business. And if you've got $100 to invest, maybe you take 40 or 50 of it and you invest it across, a broad range of sort of earlier stage opportunities. And if you're fortunate enough to have one or two companies that are real breakouts, earlier we had done it with Snap and some other companies, you want to make sure you've got lots of capital to fund those later rounds, because otherwise it's very difficult to make money in venture investing because the dilution is so significant. And so you want to continue to be able to fund the winners. And I think that's one of the biggest mistakes we see with family offices that start doing direct investing. And then, they thought that the growth stage market was too pricey or they couldn't get access. So they went into early stage or seed investing. And they didn't reserve any capital, and they ended up putting out all their money in, some smaller or larger group of companies. And at the end of the day, more often than not, they ended up losing money or making nothing for their time and effort. But for us, it's very clear. We want to continue to back winners in our portfolio. And I think that also is absolutely imperative if you want to have continued access to new companies going forward, having been a very good and supportive LP, not in lots of areas, probably the least of which is just continuing to provide capital, but it's absolutely necessary, both if you're going to make a business of it, and two, if you hope to make any money at it, at least from our perspective.
Yeah, thank you. And moving on a little bit, co-investment is gaining momentum for a lot of investors seeking lower fees and more control. And then secondaries markets have provided liquidity, significant returns over the years. But now even secondaries has subdivided into GP-led secondaries, which have pretty serious momentum. So we need this innovation, expansion in these markets, and at some point these new trends become mainstream. And so we can't turn our nose up at these things and try to I guess get in earlier because some of the gains are at those early stages. So I guess I'll start with Vishal. If you can talk a little bit about how you view GP-leds within secondaries and how that compares to co-investments, as far as whether you have different buckets for these, whether you're engaged in both of them.
Yeah, so we do have separate buckets for co-investments or direct investments versus secondaries. And even within our secondaries pools of capital, we do have some notional allocations to GP-leds, LP deals, continuation vehicles, et cetera. We did, I think, to Nash's point, there's been a phenomenal growth in the GP-led side. There's been a lot of capital that's been raised specifically for GP-led strategies. We've been very active, leading some, participating in others, and it's competitive. I mean, pricing can be challenging sometimes, and so I think we are trying to be mindful of where we're picking our spots, where we have strong angles with GPs or the underlying portfolio. That's becoming increasingly important. And GP quality is a big factor as well. So I think it's definitely top of mind for us. The potential re-rating of portfolios is top of mind with potential multiple contraction down the line. And so I think all those elements are important into our sort of overall portfolio construction approach.
Yeah, thanks. And John, did you have some thoughts around how you're handling secondaries and co-investments, since they can overlap?
Yeah, well, if you're specifically talking about sort of that intersection around GP LEDs, we really think about GP LEDs more as a co-investment. I mean, just the way we're thinking about you're doing the diligence on one or two generally assets in that GP led continuation vehicle for the most part. That's putting aside sort of GP restructuring, which is a little bit of a different category. But these continuation vehicles are generally one or two assets. So we're going, as deep and probably even deeper as we would on a co-investment because we've got a huge amount of information to work with. And so from a process standpoint, that's how we think about it. We think it's a very interesting market, tying to a lot of, agreeing with a lot of the comments that Nash has made and even tying to some of the comments Howard just made around backing winners. I mean, that's what this is, right? It's identifying fantastic companies in your portfolio that you want to live with longer. And, given our focus on the smaller end of the market, we've got dozens and dozens of relationships with, $100 to $500 million funds that own hundreds of companies that, they're working to take from 5 million of EBITDA to 20 million of EBITDA. And the industry, that part of the ecosystem is sick and tired of, making 5 times your money on a deal, which don't get me wrong is great, but then selling it to a mid-market PE shop who makes 5 times on that deal, and then having them even sell it one more time to a larger PE fund who makes 5 times that deal because of all the hard work that smaller manager did setting up the infrastructure, setting up the management team. Now that's part of the business. It's different than venture where you can just keep participating in these rounds, as Howard was alluding to, and in a lot of ways, there's an analogy there where an early stage venture, if they have the capital and the reserves, can keep participating as those companies grow. The buyout arena has been much more, fragmented, where you sell it and sell it again and sell it again. So I think this is a super natural thing for the industry to capitalize on. And when we sit with our GPs, they're all talking about it. And again, tying to Nash's comment, no one's going to go through the brain damage of selling a company to themselves and working through the conflicts of that and worrying about the conflicts of that if it's not truly one of their best companies. And that's the point Nash made before. And, we subscribe to that. We don't think it's actually adverse selection. We think it's the opposite. We think the GPs really want to get in these businesses, or stay with these businesses. The risk to us is you naturally have to pay a market clearing price. And so that question around valuation that y'all are just alluding to is a very real one. But we like the sector and think it's a good opportunity to allocate capital to great companies.
Right. Well, that's a good lead into you, Nash. And, from what I understand, GP led started as kind of a niche market in the 90s and has blossomed into a cutting edge institutional asset class with transactions, I think, exceeding 100 billion. I think it's, taken over as far as a majority spot in secondaries. So what can you tell us about the state of the market and why GP LEDs are so dominant?
Yeah, it's now actually over 50% of secondaries, which is, for those of us who've been in the secondary space for a long time, is astounding and mind-boggling. And these GP-led deals from the beginning have all been about solving problems in the landscape of private equity. I mean, the early ones that you were mentioning were in large part spin-outs from banks or other institutions that were then turned into third-party firms. And then there's a wave of fund restructurings that came. And then out of that, we started to see, more forms, structured equity. And then finally, what we're talking about specifically here, which is single asset secondaries. And that's why I think this is, this evolution has come larger and larger, and it's crescendoed because GPs have had this problem where the structure of their funds doesn't necessarily fit the way they can maximize value for their LPs and assets. The structure 40 years ago and not with all these different possibilities in mind. And so this single asset change gives GPs the tools to provide all the stakeholders, their existing LPs, new buyers themselves, a chance to maximize value from these great companies.
Yeah, thank you. Well, all of this feeds into, that idea of longer term investment horizons, finding quality and so on and so forth, themes that, we touch on. We've got only a minute or two left. So there was a question from the box. I figured at least try to get one of these. Do you believe that private markets are heading to a size where allocating funds efficiently could become an issue. And, within that, just running down the ranks, starting, I guess, with Howard, do you feel like the private markets have that efficiency? And is there room for new relationships in your mix?
Yeah, I don't really know that I have a good answer to that question, to the first part of the question. As it relates to the second part, we are always looking for new relationships. Going back to blockchain and Bitcoin, if we weren't creating new relationships with younger generation of entrepreneurs, we couldn't, there'd be no way to invest in this space. Same, I've gotten to I'm of a sufficient vintage myself. Not that we spend a lot of time in the hedge fund space, but it's this emerging, generation of managers that you need to look to. Whether these guys are, coming out of larger fund complexes, same in private equity, or coming to the business from some other direction. I think if you want to continue to be able to invest with top performing managers, it's sort of interesting. Part of it, and in new emerging areas, it's got to be as a result of creating new relationships, at least in part. I realize obviously the large private equity complexes have enormous capabilities and are able to attract, terrific talent. But to some degree, there's got to be a bucket or an open to buy, particularly in more emerging areas, in technology in particular, where it's going to be a younger generation of investors who are turning you on to sort of what's happening, what's next. Again, in our search for trying to figure out where the new large investment themes are originating.
Yeah, thank you. And I guess, Vishal, I haven't heard from you as recently. Is there room for new relationships? And, are things getting clogged up in terms of, efficiency in private markets?
Yeah, look, I think it's important to keep in mind that, yes, private equity is large, it's growing. There's over $2 trillion of dry powder globally today. That being said, relatively speaking, private equity penetration is still low. The US, which is still, I believe, under 2% of GDP. And so there is definitely, I think, room to grow, continue to grow within private equity. And I think as for us personally, we are continuing to selectively add managers to our portfolio while limiting churn within our existing portfolio. So we continue to feel positive looking forward.
Maneesh, did you have any thoughts on these markets?
Yeah, I guess I would echo a little bit in terms of just you've got to continue to look at the fresh crop of managers. I mean, it's just necessity. I mean, if you look at now, been investing in private equity for 20 years. I mean, the first iteration of the model was bankers who came out and felt like they had to kind of win deals on their own. And now there's a real concept of working as a business and as a company for these private equity firms and really creating kind of value add to create return. So the return generation has just changed. The way that people play it is changed. And, I think a lot of us, at least for me, I love the fund twos, fund threes, fund fours. It's just like mix of people who are very motivated and hungry and still haven't fill their pocket, but have now yet figured out their lane and how to invest and how to be a brand and kind of build their differentiated moment. And then, you get the fund fives and sixes, not to say that some firms can do it for long term. It's hard. There's generational changes. There's just changes in terms of, where they're kind of positioned in that market. So yeah, I would just, continue to advocate for folks to continue to seek and look at the new things.
Yeah, thank you. And Chris, obviously, everyone has been consumed with re-ups and so on. So is there room for new managers, and is this an efficient market?
So I think there's definitely room. I don't think the market's anywhere near efficient for a lot of the reasons Vishal was talking about in terms of penetration. For instance, I agree completely with Maneesh that it's vital to keep kind of those meetings going with those new managers. I had one about 15 minutes before this call. I have another one later today. That looking at the next crop is pretty important in terms of generational transition and seeing what's next. But at the same time, I think it's almost a back to the future moment in the sense of if as an investor you're looking to enter the marketplace, you really need kind of thinking back to the original DNA of fund of funds was bringing access to kind of a pretty opaque market. And I think almost the opposite is true now. There are just so many choices. Looking at guides like, the people on this call to access some of these opportunities is even more crucial going forward.
Yeah, thank you. And finally, John, do you have any final comments? Do you have room for anyone after re-ups?
Totally. We have a lot of room. I mean, if you look at our portfolios going back a number of years in any one of our funds, about 50% of the capital that we're doing on a primary basis is going to existing managers that we re-up with, and 50% of the capital is going to new relationships, actually. And part of the reason for that is our focus on the smaller end of the market. A lot of the number one reason we don't re-up with a group, perhaps counterintuitively, is actually that they've done extremely well and they've leveraged that success and they've grown and they've, moved up in size outside of our comfort zone. And we just feel, I mentioned this before, but the industry is constantly regenerating with groups that are spinning out or splitting off or graduating from an independent sponsor. And we think it's absolutely vital to be a early investor in a fund one or a fund two and get after that hunger factor that Maneesh was talking about. And we've seen it play out in our portfolios that those have been some of the best investments we've made over time. So we're constantly looking and there's definitely room.
Right. Well, you're certainly doing your part to create opportunities, and much appreciated. I did hold everyone here a little bit late, so I apologize, but I also thank you sincerely, all of you as speakers, for your insights. And I thank all of our guests for joining us. Our next webinar will be May 3rd, and I'm expecting to have a live LPGP event in New York City on September 7th, but then I've threatened that before, only to face some new variant or some other now routine disaster. And I'm waiting to see when we have critical mass of people in their New York offices, and eventually hope to get back to other cities as in the past. So meanwhile, we're still open to speakers and ideas for topics as we plan for those dates. And I welcome any conversations to that end or about anything. So as a final reminder, Private Markets Insider is a platform for identifying investors, funds, and deals through a relevant set of content and our community. So feel free to reach out and chat about what you see or what you'd like to be seen. And meanwhile, I sincerely wish you the best, and goodbye, everyone.